Hey everyone, Andy here. Let's talk about I bonds. They are all the rage lately, and I'll explain why. So I bond stands for inflation bond. It is a U.S. Government savings bond. Now technically it's called a bond, but it's not a bond in the same sense as like a corporate bond or a normal treasury bond that you can buy and sell through a broker or something. An I bond is a savings bond. If you ever had other U.S. savings bonds, you used to get a piece of paper. You still can for some of them. But it's really more like a savings account almost, especially an I bond, in that you can put money in. You can never, there's a guarantee to not lose value. You'll only get some amount of interest. So when the bond is done, or when you take your money out, you'll get back what you put in, plus the interest along the way. Fairly straightforward so far. What's so special about them lately, or why they're so popular lately, is that the interest rate they pay is based on the actual realized inflation as measured by the CPI-U. Specifically, every 6 months, the I bond interest is set based on what the last 6 months actual change in CPI-U was. The interest rate is on I bonds is reset or announced, or changed I should say, every May 1st and November 1st. So right now, for example, if you buy an I bond prior to, here we are, it's April 2022, if you buy it prior to May 1st, you will get an annualized rate of interest of 7.12% guaranteed. You'll get that for 6 months from when you buy it. While the new May 1st, 2022 interest rate is not yet formally announced, the math is such that the rate should be 9.62% guaranteed on an annual basis. So what will happen is if you buy prior to May 1st, you'll get a 7.12% guaranteed rate for that annual rate that you'll get for 6 months. So technically 3.56% interest over 6 months. Then the second 6 months you own that bond, you will get an annual 9.62%, which is what, 4.81% over the course of 6 months. That's quite good. Like I said, guaranteed, no downside risk. Now, we don't know what the rates will be after that. Every 6 months you own this bond, the rate resets based on what the most recent May 1st or November 1st interest change, inflation change reading was. So we don't know what's going to be after the 9.62%, or in other words, November 1st, 2022. We don't know what rate's going to be announced, but we know between now and then it's currently 7.12% annualized, followed by 9.62% annualized, where each of those you'll get for 6 months, respectively. So that's the upside. Currently really high guaranteed interest, can't lose money. How do you buy them? You buy them two ways. One is through treasurydirect.gov, which is direct from the Treasury website. You can buy them, the minimum size is $25, up to $10,000 per person. Hold that thought when I say per person. So you can buy anywhere from $25 to $10,000 to the penny, whatever you choose. Another way to buy them is through your tax return. If you get a refund on your tax return, you can use up to $5,000 of that refund to buy some more Treasury I bonds. Instead of getting your cash refund, you can buy up to $5,000 worth of I bonds. Those I bonds will come in paper form, an actual physical certificate. The denominations for those start at 50. I think it's 50, 100, 300, maybe something else, I don't remember. But there's 5 or 6 preset denominations when you buy in paper form. If you do get some that way in paper form, you can keep them as physical bonds, or you can convert them to the electronic form. I should have mentioned, when you buy from treasurydirect.gov, you only own it electronically like a bank account. You don't get physical certificates in the mail. It's just an electronic only thing. You log in, you have to create an account at treasurydirect.gov, link up a bank account, you buy I bonds that way. They only reside electronically. If you do get these paper bonds from a tax return refund, you can have them converted into electronic form in your online Treasury Direct account. So that's the upside, high guaranteed interest, currently high. I mean, again, it'll change as inflation changes over time. Maybe it'll be higher, hopefully it goes lower and inflation goes down. Buy direct from treasurydirect.gov or some through your tax return refund. The downsides are you're only limited to buying $10,000 per person per calendar year. Now, if you're an individual, if you're married, you and your spouse can each buy $10,000. If you're single, you can buy $10,000. Kids can each buy up to $10,000 through a custodial account if they're minors. If you also have a trust, this is where I'm not entirely clear. If you have like a revocable living trust, I believe the trust can additionally buy 10,000 of its own for that year. I don't think it needs its own taxpayer ID. I've gotten mixed stories on that. I haven't tried it myself personally, but if it does have its own taxpayer ID, I'm pretty certain you can buy another 10,000 for the trust for the year. Even if it doesn't, like it's a revocable living trust, I think you can still buy another 10,000. If you have a business and that business has its own separate, it's its own separate entity, has its own taxpayer ID, that business could also buy up to 10,000 per year. Now, it's not entirely clear how that interest gets reported. I've read conflicting things saying that the interest will be taxed as self-employment income, which will be subject to payroll taxes. I've read other, anecdotal stories that no, you put it, even if you buy it through a business, you report it as your own personal interest. So I don't know. It's, buyer beware. Do some more research before you attempt buying I bonds through a business you may have. So, assuming you don't have a trust or a business, you're limited to buying $10,000 worth of I bonds per year, direct from Treasury Direct, plus up to $5,000 per tax return. Whether you're single or you're married and file a joint return, it's $5,000 per return, not per name on that return. So each individual, $10,000 direct through Treasury Direct, plus up to $5,000 more purchased through tax return refund if you get a refund. You cannot buy them through an IRA or Roth IRA. You can only buy them with like normal after-tax money, so straight from your bank account. So unfortunately, you cannot buy these. You can't buy them through a broker. You can't buy them through your IRA or Roth IRA. You can only buy them direct with bank account money, already taxed money, direct through treasurydirect.gov, or again your tax return refund. So the way it works is, as I mentioned, the interest rate changes every 6 months. They will earn interest for 30 years. So if you can hold the bond up to 30 years, it'll continue earning this interest at a new interest rate every 6 months. At the end of 30 years, it's done. It earns no more interest. At that point, there's really no point in keeping it. It'll just sit there. It's not going to lose value. It'll just sit there, but it's not going to earn any more. So you would presumably cash it out on the 30th year if you didn't already cash it out prior. One other big restriction, like I said, other than the limitation on how much you can buy each year, is that when you do buy or put money new into an I bond, you cannot redeem it at all for the first 12 months after your purchase. It's flat out completely restricted. You can't get the money out. So don't put money in if this is money you're going to need in the next few months. You need to leave it in there for 1 year. Between 1 year and 5 years, if you take it out, there'll be a bit of a penalty. That penalty specifically is foregoing or giving up the most recent 3 months of interest that you earned, which isn't that terrible of a penalty in my opinion. But just be aware of the penalties there. If you own it more than 5 years and you redeem out of it after 5 years, there's no penalty whatsoever. You'll simply get your interest, and there you go. The interest on these is fully taxable at the federal level, tax-free at the state level. Even if you live in a state that does have income tax, the interest on I bonds is not taxed. Now, by default, the interest that you get on these will accrue. You're not going to have to, I'm fairly certain, you don't have to realize and pay tax on the interest throughout the years, as long as you don't redeem out the bond. If you just keep the bond, let the interest kind of snowball and accrue, you'll eventually have to pay tax on it when you do cash out and redeem your I bond. Then all that interest accrued will be taxable at the time you take it out. And you redeem it through Treasury Direct, assuming you have it, electronic bonds. Just like you buy it through a few button clicks on Treasury Direct, you'd also redeem it through a few button clicks. You'd have to link up a bank account, and they'll send the money out to your bank account. Now, if you have a paper bond that you bought through tax return refund, you did not convert it to electric. I'm frankly not sure exactly of the redemption process. I think maybe you can mail it in or something to the Treasury, or I believe some banks will cash them and pay you out, the principal plus the interest. But I'd have to look more into that. I'm not entirely sure. It's probably easier. I don't know if there's anything I'm missing, but probably easier if you do have paper bonds to convert them to electric, electronic form. But who knows? Maybe there's something I'm not aware of where it doesn't make sense to keep them in paper form. So that's it. Hope you found this helpful. We'll see you next time. Take care.